talking about investments, we're talking numbers. We're talking dollar signs. Real Estate Lab. What's up, guys? Welcome to Chapter 5. We're going to talk all about the numbers. This is a lot of people's maybe least favorite section, but it is extremely important in this business. You know, every business has their kind of main key skill sets, key points that you have to really understand and know. And in commercial real estate, one of the biggest ones is numbers. This is, at the end of the day, a financial business. We are running a financial business. It comes down to the numbers. We're buying investment properties. And when you're talking about investments, we're talking numbers. We're talking dollar signs. And there's a lot that goes into it. And so I am going to show you guys, and we could pop up our screen share here really quick. And I'm going to go through some common terms and definitions. I'm going to show you guys what a financial statement is. I'm going to talk a little bit about underwriting and analysis. This chapter, we're going to go over in depth, how do we figure out what price to pay for a property, right? I'm going to show you guys start to finish how to do that. How do we understand the numbers, return on investment? This is something that you guys will watch, and you'll probably want to watch again, right? I think the definitions and the parts of the income statement you'll learn a little quicker. In terms of the actual underwriting process and the in-depth underwriting, it's going to take a lot of practice. So you're going to have some homework for sure at the end of this that I'm going to give to you guys practicing the underwriting process. But first, we're just going to go through some definitions, and I want to make sure you guys have a good understanding of what we're talking about, and you guys get a nice foundation so that when we get into the more complicated section, the complicated part of this stuff, it's a little easier to grasp. Starting off, what is underwriting? What is analyzing a property? You can call it financial modeling, right? Basically what we're doing is we are taking data points and information on a property. We are putting it into a tool, an underwriting model or financial model or an analyzer, many different words for it. And that model, underwriting model, is going to spit out certain numbers, certain metrics. And what we're doing is we're interpreting these numbers. Normally they are return on investment, cash on cash, internal rate of return or IRR, equity multiple. And we're looking at these numbers and we're saying, okay, is this a good investment at this purchase price with all these other factors taken into account? That's what the underwriting process looks like. And we're going to be using our Real Estate Lab software that our company has developed and built for you guys to use and for multifamily investors, so that you can go through this underwriting process. So for you guys to understand this and to get this foundation, I'm going to go through some key terms and definitions that you're going to see on this page here. This is a little ebook that we've made on the financial side of the multifamily business. So first off, you guys need to understand what a income statement is. And an income statement is basically, it's called a couple different things, year-end financial statement, a profit and loss statement, a T12, trailing 12. This isn't necessarily a picture of a trailing 12 right here. This is just a 1 year financial statement, a year-end financial statement or an income statement. And what it is it shows our income, vacancy, gross income, our operating expenses, net operating income, our debt service, and our net income. So this is what the property made this year. This is what we spent this year. This is our mortgage payment or payments, and this is what we net. It's our net income. So let's break that down into a couple different pieces, right? Because there's a lot of important pieces of this. Gross potential income. This is what our potential income is. Gross potential income is what our potential income is if there were no vacancy, no loss to lease, no bad debt, no concessions. And I'm going to go over some of those items a little bit later on. But basically, what would we make? Gross potential rent is what would we make if we had a perfectly operating property? We collected every dollar on time within the year, and everything was 100% perfect. Now, this never happens. It's almost never happens. 99.99% of the time, this does not happen. We always take into account some vacancy, Vacancy losses, concessions, bad debt. Bad debt, by the way, is if a tenant, let's say, moves out, or we evict someone and they had unpaid rent and we can't collect that, that's what we write off as bad debt. So, and concessions are one-time discounts. So, hey, a $500 move-in discount if you move in this month or sign a lease. So, after that, vacancy loss. Vacancy, you guys understand vacancy is just loss of income due to a unit not being occupied. So an apartment is not occupied for a period of time. That is deducted from our gross potential income, right? We're not able to hit our total potential because we've had some vacancy. This leads us to our gross income, right? And other people might call it other terms, so I call it the gross income because this is our potential. This is what we lost out of that potential, and this is what we actually collected. So our gross income can be defined as the actual operating income, the amount of money that we collected in this time period. From that, we are going to subtract 40 from the 95,000. We're going to subtract this 45,000, which is a total of all these numbers. Again, and guys, you'll see this, and this is the way I operate in financing. The positive numbers are written like this. Negative numbers have parentheses. So you'll see, I think it's self-explanatory, but 95,000 was 100,000 minus the 5,000. This is a negative if it's in parentheses. These are all negatives. So this is income is positive, expenses are negative. So operating expenses. What are our operating expenses? These are expenses that we see in standard operations of the property. Advertising. Contract services. What is contract services? Those are alarm contracts, security contracts, landscaping contracts, any type of contract that we're paying on a contractual basis. Those things get thrown into this category. General and administrative expenses. These are office expenses, hiring expenses, stuff like that. Insurance, it's self-explanatory. Management fees, also self-explanatory. It's property management company fees. Repairs and maintenance. These are costs for standard operating repairs and maintenance. We would not include in here, for example, replacing a parking lot or replacing a roof, or we went through and replaced all the windows at a property. Those are different items that we're calling capital expenditures or CapEx. You're going to see CapEx a lot. CapEx is not an item. Those are not items that we include in the operating expenses. Below that, so we're going to take our gross income. We're going to subtract our operating expenses. And from that, we get the almighty net operating income. This is a really important number, and net operating income, or NOI, which is defined as operating income minus operating expenses. So what's our gross income minus the operating expenses is our net operating income. So this dollar amount, the net operating income, could also be defined as the amount of money one would make if they bought a property cash. If you bought this property cash, because then you wouldn't have any debt service. If you bought a property cash, you don't have a mortgage. The only two items that we do not include in the net operating income calculation, two items, write this down, are capital expenditures, CapEx, which I said are not operating expenses. Those are one-time, one-off, major renovation amounts. And we do not include debt service. So, debt service and CapEx. Those are two items that are not included in the net operating income calculation. Debt service is below the line. What we call the line. You'll hear this a lot. Below the line. That is below net operating income. That is the line, right? Because that's an important number that we need to know. So from there, we take our NOI, we subtract out our debt service, and this is our net income is what we end up with. And the net income is our actual take-home cash flow. So this property, by the end of the year, if I had put all of my income, net operating income, right? I put my gross income into the bank account. I spend my expenses every month. I spend my mortgage payment every month. At the end of the year, I should have $30,000 left over. That would be my net income. All right. CapEx would also come out of this net income potentially, or it would come out of reserves that you have. So once again, we don't include that in NOI. Why don't we include those in NOI? Because not everyone buys a property with debt. And this will make more sense in a minute, because net operating income is what we use to determine the value of a property. That's why this number is so important, because this number determines how much your property is worth. It may sound a little strange if you're not familiar with it, but this number, NOI, determines what your property is worth. And I'll show you how that happens in a bit. So because not everybody uses debt service or a mortgage, and not everybody uses the same kind of debt, we can't include that in how we value a property because that's not standard. But all the rest of this is standard, right? Everybody's going to collect rents, and everybody's going to have operating expenses. Now, some people will have higher rents because they manage it better, or higher collections because they manage it better, and some people will have lower expenses because they manage it better, or higher expenses because they don't manage it very well. And that will influence how much the property is worth. The higher, and I'm sure you guys can assume this, but the higher the net operating income, the higher the value of the property. The more money it makes, the more it's worth. So net income does not matter for the value of the property. You could spend $50,000 in debt payments, and your property would still be worth the same because it's not going to affect your net operating income. You might make less cash, but your NOI is going to stay the same. So debt service we talked about, that is your mortgage payments. Net income is your take-home cash flow. Okay, let's move on. So let's talk about lending terminology. Banks, we use financing in this business. You guys need to understand how financing works. There's a whole section later on I'm going to go through about financing, by the way. So this is not the end-all, be-all section. I'm going to go over it much more in depth, but I want you guys to understand all these things before we get into underwriting. So loan term. This is the term. That's the special word, is our term. It is the length of the loan, the time period that we have the loan until we have to pay it back. A lot of people get loan term and amortization mixed up. Don't do that. They're different things. So let me explain amortization, and then I'll circle back around. Amortization is used to describe a length of time that the principal is to be paid over. A longer loan amortization means more interest is paid over time, but lower monthly payments. We normally see amortization between 20 and 25 years and 30 years if you have a good banking relationship, prior experience, or are using agency loans. So, amortization, let me break it down a little bit for you. Normally 20 to 30 years. It's in increments of 20, 25, or 30 is common. There are such loans as 15s, but it's uncommon. How amortization works, if you guys have ever gotten a loan, you understand that your monthly payment, you have the same monthly payment for the entirety of your loan, normally, unless there's an interest-only period, but you have the same payment. A portion of that goes to paying down the principal of the loan. So let's say your loan is $100,000. Your monthly payment is $4,000. You make your first payment. Your balance doesn't go from $100,000 to $96,000. It doesn't go down by $4,000. They amortize the interest rate into your $4,000 payment, meaning that up front, you may pay $4,000 in your first month. $3,000 of that could be interest, and $1,000 of that could be the principal. So you pay that first payment of $4,000, you actually still owe the bank $99,000, and they just collected $3,000 in interest and applied $1,000 of it to your principal balance. Over time, the more payments you make, the more that scale evens out to where eventually, maybe in 10, 15 years, every payment, 1,000 of it is interest and 3,000 of it is actually paying down the principal. So what happens is the bank gives you a amortization and a interest rate. The higher the amortization, we like higher amortizations. 30 years is ideal. Most smaller banks will do up to 25, not 30 normally. Bigger banks and agency lenders, which we'll go over later, they will do 30 years normally. 30 years is better because you're going to have a lower monthly payment. The lower your monthly payment, let's go back up. The lower your monthly payment, the more cash flow you're going to make. So let's say in this scenario, we have a 30-year amortization. Our payment annually is $20,000. If the bank gave us a 20-year amortization, our payment might be $35,000. It might be a lot higher, right? And so we're going to make $15,000 less on our net income in that scenario. And so we're going to pay the loan down quicker. So our loan balance actually gets paid down quicker. However, we're going to have less cash flow. So I'd say in most scenarios in buying apartments, the longer amortization is better. You get more cash flow along the way. It's a little safer because you have a less of a payment to make every month. Your payment's lower. And you're going to feel a little bit safer because that payment's lower. So you're just paying the loan down a little bit slower. But what we do in multifamily normally, and we're going to go over this, we add value to the property, right? Our goal is to buy a property for $1 million, for example, and bring the value up to $2 million. And I'm going to show you guys how to do that. So in that case, it really doesn't matter if we're paying the loan down quickly because we're adding so much value. So what we really want is a longer amortization, lower monthly payment. Okay. So going back to the loan term, we might have a 30-year amortization on our loan, but the loan is only a 5-year loan, meaning that in 5 years, the bank requires us to pay them back whatever our principal balance is remaining. Principal is another way of saying your loan balance. Whatever that $100,000 loan, if we pay it over 5 years, we might owe $76,000 at the end of that 5 years. The bank is going to require us after 5 years. It's called a balloon payment. The bank's going to require us to pay it back at the end of 5 years. Some banks will give you extensions. Some banks will not give you extensions. Some banks will fix your interest rate for 5 years, and then after 5 years, it extends the loan for another 5, but it's a floating interest rate, which means it's a variable interest rate. The interest will go up when the treasury goes up or down. So different types of loans have different terms. You can either pay off a loan at the end of that balloon or loan term. You can pay that loan off with a refinance or with either that bank or another bank, or by selling the property. Those are the two ways. Or you can pay it off if you have the cash. So those are term and amortization. Loan to value is expressed as a percentage. This is a ratio of the loan amount to the purchase price, or sometimes it's loan to cost, and that would be loan amount to the project cost. So example, $1 million purchase price of a property with an LTV of 75% would mean that the bank will finance 75% or $750,000, and you will need to pay $250,000 as your down payment. Recourse versus non-recourse debt. So there are two types of loans, recourse and non-recourse. Non-recourse is better. What is recourse? Recourse means you are backing this debt and you are fully guaranteeing that this debt will be repaid. Personally, you are guaranteeing that. We buy every property in a limited liability company, or it's an LLC. So every company we buy or every property we buy has its own LLC that owns it. So the bank lends money to that LLC, right? Bank lends money to that LLC. That LLC is there to protect us, the owners, from liability. We own interest in the LLC. The LLC owns the property. We are signing on as guarantors, though, even though the LLC is going to guarantee the loan, the owners of the LLC are also going to guarantee the loan. However, in a non-recourse scenario, non-recourse loan means that the bank's collateral is limited to the legal entity or the property, or the legal entity or the LLC that owns the property and everything that's in it, right? So if you guys can imagine, we have the property, LLC owns the property, owners own interest in the LLC. In a non-recourse scenario, the bank only has collateral of the LLC and everything the LLC owns, which is just that property and its bank accounts. It does not have the ability to come after the owners. The bank cannot come after the owners in a non-recourse scenario. In a full recourse scenario, you are signing a full personal guarantee, which means you sign all your personal assets as collateral. And in a full recourse scenario, if you default on that loan, the bank can come after you personally. In a non-recourse debt scenario, means that the limit to the bank's collateral is the property or the legal entity that is being lent to. In most cases, this is an LLC that is holding ownership of the property. This offers the least protection for the bank and the most protection for the borrower. Non-recourse debt is common on large multifamily properties from agency lenders such as HUD, Freddie Mac, and Fannie Mae as most common. Most banks, regional small banks and credit unions, are full recourse lenders. It's very common. So you want non-recourse, but understand that it's not always your choice. The bank makes the call. Not all banks are going to lend without recourse. And the ones that do lend without recourse normally are lending on stabilized properties to sophisticated or qualified or experienced owners and operators. Okay. Loan origination fee. This is the fee that you will pay to a bank or a mortgage broker to get a loan. Don't be upset or swayed if they're charging you this fee. It's very common. Normally, I would say most of the loans average 1% of the loan amount you're going to pay as a fee when you close on the loan. All right, debt service coverage ratio. So I'm going to go back up. This is the equation for debt service coverage ratio. NOI divided by your debt payments is your debt service coverage ratio. So let's go back up. Our NOI, $50,000, divided by debt service equals our DSCR. So in this case, it would be 2.5. 50,000 divided by 20,000 is 2.5. That's our debt service coverage ratio, which, by the way, is a phenomenal debt service coverage ratio. Most DSCRs are in the range of 1.25 to 1.5, maybe up to 2. So basically what it's saying is, how safe is this asset in terms of covering the debt? We never want to be in a scenario where we can't cover the mortgage payment. So banks look at this number, or this figure called debt service coverage ratio. They want to know how much money the property's making at the end of the day, which is the NOI, to cover the debt, right? Because NOI is the number right before the debt. So how at what multiple are we covering our debt service payments? That's DSCR. Example, if our NOI is $400,000, our debt payments are $250,000, we have a 1.6 DSCR. Most banks underwrite deals to a minimum of 1.2 or 1.25 DSCR. If it's below that, for example, if we had $50,000 in NOI, but our debt service was $47,000, that is 1.06 DSCR, which I would never want to buy that deal anyways because I'm only making $3,000 and I'm barely covering my mortgage payments. But the bank will not lend to you with that DSCR. Okay. Continuing on. Pro forma. What is a pro forma? A pro forma is a type of financial statement used in real estate transactions to project the possible or potential financial performance of a property or a group of properties. So, pro forma basically said is it is a projection of what we think our income and expenses will be. So basically, we're taking our income statement, and this is what actually happened over the last year, and then we're going to make a pro forma, which is this is what we expect to happen in the next year or years going forward. So pro forma, also known as projections. You'll very commonly hear people call your underwriting model or analyzer a pro forma. Hey, send me over your pro forma. Send me over your projections or your financial expectations. Mayo, it's a term frequently used in single-family residential, but I put it in here. But what's your maximum allowable offer? What is the max price you can offer on this property before it doesn't make sense anymore? Same thing in single-family as multifamily. There's always a price that you should not go over. There's a price that makes sense and a price that doesn't. And in multifamily real estate and commercial real estate, remember this, write this down. It's one of the most important things ever. You make money when you buy, not when you sell. I know it sounds a little tricky, right? You make money when you buy, not when you sell. You make money when you buy. And what that means is if you buy a property for the right price, you're always going to be good. You're in the money. That's when you make money. If you overpay for a property, you pay too much, you could be in a very scary situation, a very sticky situation. You may never make any money. So in commercial real estate, you make money when you buy. What is a cap rate? I'm going to go over cap rates basically, and I might go over them a little bit more in a separate video. But a cap rate of a real estate transaction is a ratio of the net operating income to the purchase price, expressed as a percentage. So a lot of people get confused with cap rates. I'll continue this definition. Cap rates are also a way of determining what is the possible market value of a property based on what the market cap rate is in that specific area. Market cap rates are a good way to determine the market value because they look at every deal on an even playing field by using NOI, excluding debt service, as I told you guys before, instead of net income, because the financing terms can be different for each transaction and each sponsor. So, equation for NOI. And this is going to take a little while to grasp. I know when I was first getting started, I didn't really understand cap rates. But once you see how it works a couple times in actual practice, it will make a lot more sense. So the equation is net operating income divided by the purchase price of a property equals the cap rate that you bought the property for. Cap rate can be used in a couple different ways, 2 or 3 different ways. So, for example, if the NOI of a property is $100,000 when you bought it, and you bought the property for $1.2 million, the cap rate of this transaction is 8.3% of that transaction. That does not mean the market cap rate is 8.3%. That means what you bought the property for is 8.3%. Secondly, the market cap rate in a certain city is 8.5%. For example, you are analyzing a property with an NOI of $250,000, and you see that the NOI is $250,000 on the financial statements. The market value of this property may be estimated at $2.9 million, $2.941 million. I'm going to go over this in a couple other scenarios in a separate video, but this is just an introduction to what cap rates are. They can be used in multiple different ways. A third way they can be used is to project out what the value of your property would be, right? So maybe we bought this property at an 8.3 cap rate. That is set in stone. The NOI was $100,000 and you bought it for 1.2. So you bought this property for 8.3. However, that doesn't mean the market cap rate was 8.3%. What if the market cap rate in that area was 6%? That means that the property is actually worth $1.6 million, and you bought it for 1.2. The market cap rate is 6%, not 8.3. So you got it for a great deal. Market cap rates are determined by aggregating the actual transaction cap rates like this. Example 1, aggregating these cap rates across a market or an area, specific area, and a specific type of property, right? Newer property versus an older property. We talked earlier about class ABC. Each one of those classes has a different cap rate in each market. And this is something that there is data online. You could look them up. At the end of the day, once you get familiar with an area, you're just going to understand and know what the market cap rates are. However, Google it online. Hey, what's the cap rate in my area? There are resources online to figure that out. So, like I said, market cap rate is determined by just tracking all of the sales, right? And like I said, there are companies out there that track this, but just tracking all the sales and seeing what things are selling for. If this same property sold for 1.6, that would be a 6% cap rate, like we said, or just around a 6% cap rate. And if a lot of properties were trading around 6% cap rates, the market cap would be 6%. And so if we know the market cap rate, we can pretty easily estimate what the value of other properties are and what's a good and a bad deal. The higher the cap rate on the buy, the better. You want to buy at a high cap rate and you want to sell at a low cap rate. Or you can buy and sell at the same cap rate as long as you're increasing your net operating income. Let me give you another example. If I bought this property for $1.2 million, $100,000 NOI, I am going to go in and increase the rents. Let's say I have a 30-unit property and I increase the rents $200 per unit per month times 12 months. I increase the income by $72,000, which then reflects my net operating income, a $72,000 increase. So let's say my NOI is now $172,000, and I sell it for the same cap rate, 8.3 cap rate. So the market didn't improve, didn't change or anything. Same cap rate. My value is now almost $2.1 million, $2,072,000, because I increased the rents by $200 times 30 units. So now you guys can see when we increase our NOI, the value exponentially increases. Now, if in that same scenario, let's say the market improved. Let's say you bought this property back in 2017 at an 8.3 cap rate. Now the market's at a 6 cap. Well, we also increased the rents and the NOI by $72,000 still, and now we're selling it at a 6 cap. The value is now $2.86 million. It's more than doubled from the 1.2 that we bought it at. And that's because we increased the rents and the market improved, so the market cap rates went down. And so now the property is worth $2.86 million. That is the power of commercial real estate, how we can amplify these values and really exponentially grow the value. It's incredible. So you still may have a hard time grasping that. I'm going to go through it a bunch during this course. I'm going to do another video just on cap rates so you understand it. You're really not going to know until you put it in practice. You're not going to know it that well. It takes some practice and seeing real life examples to understand how that works. Okay. Cash on cash. / return on investment. Cash on cash is the actual cash that you put up or invested, capital invested to buy a property, divided by, it is the cash flow that you make divided by the capital that you invested to buy a property. So if I invested $100,000 and I made $10,000 in a year, I made 10% that year. It's basically the return on your investment in a specific year or over the course of an investment, right? You could have an overall cash on cash return, or you can have an annual cash on cash return. Normally, it's annual cash on cash return is what we're looking at. We want to see, hey, how much money are we making on our money? What is a syndication? A syndication is a method of investing where a general partner brings together outside investors in order to fund a real estate transaction. And in return for doing that, the general partner or partners provides the investors with targeted returns paid from earnings of the deal. So, a syndication, and I have a whole section we're going to go through on syndication. Basically, it is where I go out and let's say I don't have the money to buy a property myself, or I don't want to buy the property all by myself. I'm going to pool a bunch of investors together. They're going to invest into a specific property fund to buy a specific property, and I'm going to give them a certain ROI on their money or a projected ROI, or I'm going to structure the deal in such a way that they return a certain payouts, whether it's through a preferred return, certain splits of the income. It could be structured in so many different ways. We'll go over all that. But a syndication is basically just a way of funding a deal. If I have the money, I can go write a $400,000 check and go buy a 15-unit property on my own. Or I can go get that $400,000 from 10 friends, 10 people, and they can put the money up, and I'll buy that property and give them a piece of the deal for doing that. And then I get a piece of sweat equity. So, economic occupancy. It's a measure of the property's performance of the current income as it relates to the potential income. So, in this scenario, our economic, this is our physical occupancy in this scenario. It could be across the board, right? It could be 98%, it could be 92%. Vacancy here, maybe this verbiage is not technically correct, but I should also have vacancy loss, concessions, bad debt. Economic occupancy is basically a metric saying what percent of the income did we collect, or what percent of the potential income did we collect. So let's say that I don't know if the example is necessarily correct here. So it doesn't give the full picture, at least. Let's say that we have a potential income of $100,000 and our occupancy was 95%. So we lost $5,000 in occupancy. We also didn't lease our units at full market rents. So we have a little bit of loss to lease there. We also had 2 people we had to evict, and we lost another $2,000 or $3,000. So let's say we actually collected $90,000 that year, and our potential was $100,000. Our economic occupancy is 90%. Basically stated, our economic occupancy is our how much money did we collect divided by what was our potential total collections. So what percentage of our potential are we reaching? That's economic occupancy. Physical occupancy is how many units are leased to the total number of units. What percentage of units are actually leased? So that's the next one here. So sponsor. A sponsor, and normally it's a loan sponsor, is what we're talking about. The loan sponsor is somebody that is able to help us obtain and qualify for a loan guarantor. Also, sponsors, it's in other words interchangeable for who is leading a deal. A general partner is also what they could be called. Normally, this is in syndication world, in syndication business. The general partner or the sponsors are the people that are putting the deal together. Okay. Location class, property class. We went through these already in another video, so I'm going to skip over those. What is a unit mix? A unit mix is the specific mix of unit types at a property, normally detailed out by bedroom and number of bedrooms and bathrooms, and they're normally delineated by the unit type as well. And what we're going to see in a unit mix is how many units of each type are there, what's the square footage, how many bedrooms, how many bathrooms, and how many are occupied, what are the average effective rents that they're currently getting for each unit type, and what are the market rents for each unit type, like what should they be getting. So that's what a unit mix is. It basically just breaks down what different types of units are at a property, what different types of apartments. So guys, that is, I can go over, I'll go over one more thing. I have talked about this before, the rent rolls and T12s with you guys. I'll show you an example here of a rent roll. I think I've already showed you one, but here's a rent roll. I blanked out the occupants' names, but basically it shows monthly rent, square footage, rent, lease start, lease end, deposits. A unit mix is going to show us a condensed version of this, and it's going to combine each unit type into one row, and it's going to show us how many units of each type. Operating statements, we've gone over this, year-end or trailing T12. You'll be able to see in here. Basically an operating statement is normally it's an income statement, but it shows month by month over 12 months. It's going to show us a T12, 12-month, month by month financial statement. So those are a bunch of basic general financial terms. You're going to learn a lot more in the next video when I actually show you in practice what a simple income statement or pro forma, what a simple pro forma looks like for an apartment building that we're going to look at. We're going to look at an actual example. So I will catch you guys in the next section. Thanks.